All right, so we do have a situation we wanted to talk about this week. Vivian and Scott, who are 48 and 50 years of age, got kids 22 and 23. Why is it that I'm a little older than them and my kids are much younger than that? Anyway, Vivian and Scott have been with their advisor, wealth manager, for several years now. They're invested primarily in high-quality, large-cap equities. That sounds familiar, much like we would recommend. Mm-hmm. They're wondering why their advisor is not capitalizing on the trends like the current run in GameStop or AMC and even the cryptocurrency craze. You guys getting questions about that?
Well, we certainly were.
Yes, but some are more as a joke.
Oh,
but
well,
a few questions.
That's true.
I'll be honest with you. Usually, if questions get too serious, I wind up looking at them, and I haven't heard but maybe one or two with GameStop. But it seems like every advisor I talk to will answer the phone and say, "Hey, man, have you bought my GameStop yet?" As a joke. It's become kind of an industry joke behind the scenes. So we wanted to talk a little bit about, why your advisor is not likely to buy you GameStop or AMC when things like this are going on.
Seriously, though, when I tell people Apple's been up, 80+% past 2 years.
170.
Yeah.
In 2 years.
And the earnings have been, virtually flat.
Yeah, they're
they've
less
been up
than
a little
10%.
bit. But, yeah, so how – and that's where the questions are coming from, I think, because it's like, so then what are the chances that the earnings can even catch up? Does that make it more likely that Apple's going to experience that reckoning because it's just too far along?
Yeah, do you think that it's reasonable?
Hell no.
Oh, yeah, neither do I. There's a lot of things that don't look reasonable in the market right now. So, we wanted to cover investing and then speculation, which actually has a place in markets, and then gambling, which has a place as well. What we think is happening with GameStop and AMC obviously is probably toward the lower end of that. Yep. But let's face it, what we do is a long-term game. We look to find investments, and by that I mean whether it be real estate, whether it be a stock, whether it be a business that you're going to go in and operate. An investor wants to determine what the future cash flows are going to be. They understand, to some extent, their cost of capital. Obviously, that moves with the market as interest rates move. But, they use that cost of capital to discount back to the current value, the present value, those future cash flows, right?
Yeah.
And that's what we would call an intrinsic value. Fundamentals.
Which will never change, by the way. I mean,
that story, you're right. That process doesn't change, ever. So, here we are looking at it from the point of view of an analyst. And it makes no sense. GameStop started this craze at like $19 a share.
Yeah.
I wouldn't have bought GameStop at $19 a share. Let me see that. I'm going to read a little of it so that they can share along with us on the YouTube, whatever it is. Yeah, the
on that World Wide Web thing you're talking about?
Yeah. Whatever that thing is. The story is, and I'm sure if you've been paying halfway attention, you understand what's going on. GameStop became the focus of a Reddit thread. Some people on Reddit, which is social media, an old bulletin board type, social media decided that they were going to catch these guys that were short the stock. They'd start running the price up. What happens when you run the price up on a stock that has been shorted? They begin to get collateral. Yeah, they begin to get collateral calls, and they have to buy out of their short position.
Which drops the price upwards.
Yep.
Right. Yeah. So I think it was smart. They did to hedge funds what hedge funds have done to lots of people for a long time. But they were able to identify something that was wrong in the market, and basically the thing that was wrong in the market was the shorts, actually the float, so the number of shares available in the market were exceeded by the amount that was sold short.
Yeah.
And they knew that they had them kind of over a barrel. So
wasn't it like 120%?
130, yeah, is what I've heard. Yeah,
Yeah.
I heard reported 130.
The thing is, though, it's all artificial. I had someone ask me during that, when it was just going crazy about if that was an indication that things are moving away from the more traditional, fundamental way that we value companies. And I said, absolutely not.
Yeah.
I don't think that will ever change because the true value of something, as you said, is
Right.
that discounted cash flow stream that, the company itself has. There's not a better way. That's been around for, 70 to 80 years at least.
What do you mean, analysis?
Just
Fun-
the
fundamentals.
stock
Yeah, this was-
valuation.
Yeah.
I mean,
This
that-
was Benjamin Graham, the investor who taught Warren Buffett everything.
Exactly.
He knows. Warren Buffett's 86 years old? Mm-hmm. So Warren Buffett was a young man when this all started.
Right.
So
It's not moving away from that.
no, absolutely
this is
not.
It's
I
an
guarantee
anomaly.
you. Do this. Decide you're going to go buy a business, an operating business, and you're going to run it.
Yeah.
And then go to the bank and tell them that you want to borrow some money and have them talk to the owner. The owner says, well, I only make $100 a year,
Yeah.
but I think the business is worth $10 million. You go back and tell the banker that, and you're not going to get the money.
Yeah, a lot of people learn that the hard way on Shark Tank, if you've ever seen that show.
Right.
They always ask them, why do you value your business at whatever they're asking for, right?
Sure.
They do the math and
Right.
see what it's worth. It's the same thing here, and it always will be. That is an artificial rise in price that is an anomaly because
Yeah.
markets are efficient.
Right. I
And-
speak of it in terms of the price has dislocated from
Yeah.
the fundamentals.
Now, that's
Yes.
a good way to put it.
Right. And what winds up happening is at some point, like I said, long term, you're going to be much better off if you focus on the fundamentals. Don't get caught up in what's going on in the price. That's a trader's game. Here's the other thing. When it comes to speculation, speculator buys and sells in hopes of having a bigger potential gain than the amount he risks. So when you're dealing with that, and by the way, there is a good place in the market for speculators, and I'll tell you where it is. Companies hedge the cost of their inputs, right? Mm-hmm. You know who takes the opposite of their position? Who will offset that position? It's a speculator,
Right.
Somebody that believes, that. So the company thinks that prices of fuel, diesel fuel,
Yeah.
are going to
Well,
go
for the
up.
airlines, I mean, they have.
Airlines do it.
Yeah,
Yeah,
yeah.
there's a lot of them. It's talking about, in our opinion, there's a lot of nonsense in financial markets at the moment. It's hard to know whether one should take much of anything seriously until this period of euphoria ends. We are analysts, so it's better to have something to recommend, even if it's just on a relative basis. We like Uber. He goes on, but it's you can kind of get the feel for what's going on in the market. An analyst like me, I feel like I'm swimming underwater with no scuba tank. It's bizarre. None of this makes sense. Guys, before the break, we were going over a situation with Vivian and Scott. They're in their late 40s, early 50s, got a couple of kids. Really the biggest thing that they wanted to know about is why their advisor didn't buy them GameStop or AMC stock. And I went through the notion about looking at the fundamentals. Basically, when you invest in anything, you're looking for a future stream of cash flows. It's about the cash flow, always about the cash flow. And in order to get the value of that cash flow at present value, you have to determine your discount rate, which is your weighted average cost of capital.
We get into the CAPM model right now?
Yeah, I mean, no.
We'll save that for another show.
We could do that, but no. So it's the same. No matter whether you're looking at an operating business you're going to go and buy, whether you're buying a stock in the stock market, or whether you're buying real estate, it all boils down to that cash flow and what is it worth today. So we went over the fact that that's what investing is. Speculation, we know there is reason to speculate in the market because without speculators, you couldn't hedge those operational inputs. Raw materials are one of the main, if it's a trucking company or a cruise line or an airline, the lifeblood of those businesses is crude oil. So quite often they'll either hedge the crude oil prices in case they should go up in the future, and quite often they're not doing that in a like trying to call a price increase.
Right.
Basically, all they're doing is trying to lock in prices. They love to know what their costs are going to be. It helps them set prices for the future so that they can maintain profitability. The person on the other side of that trade is a speculator.
Yeah.
Every single time. Sometimes a speculator might feel like they know something that the hedger doesn't care about, so they're going to get into the deal anyway. Sometimes they win, sometimes they lose. It's not uncommon. What we saw, I mean, even this, I've seen individual investors come to me and say, "Hey, look, I want to buy this pharmaceutical company. They've got this real interesting new drug, and I think once it gets approved by the FDA, it's going to go like gangbusters, and the price of the stock is going to go crazy." I mean, that's a
could.
speculation.
Yeah.
It could. Yeah. I've seen it happen.
Or you get denied and
Exactly.
it goes down.
So it's a bet.
And that happens too.
Yeah.
It is kind of it might be better than a 50-50 coin toss, but the reality is that's speculating on what comes next.
Right.
And that's money our clients should have outside of their basically retirement money. They have some play money that would not affect
Exactly.
their overall plan.
Yeah.
Sure, if you want to speculate on GameStop,
Right.
open up another account, and if you're prepared to lose it all,
Yeah.
have fun.
As an investor, it is your job to discover what the potential cash flows in the future are, discount them back to present value, and that's the price that you would want to pay for something or less.
Yeah.
What seems to have happened in this GameStop and AMC deal is individual investors, retail investors, those that aren't really as savvy as the professionals. They did catch some professionals unawares. They did make money at the cost of some professionals. But what those guys are trying to do is trade, and a trader just looks at price momentum. They don't care if the market goes up or down. They can make money either way. So in order to make money, all the market has to do is move. They take their bets or whatever. That's not what we do.
Yeah, nor do you really stand to, I think, in most cases, do better over time by doing that. Because you know what? Every now and then you're going to pick a GameStop. You're going to call it right. You're going to make a lot of money. It's going to make you want to do more of that.
Yep.
And then inevitably, because even with us, we don't pick every single one of them right. Hopefully, we pick
Correct.
more than we don't. But
To make money. But
right, exactly. At the end of the day, if you're going to have winners and losers, and probably to the extreme on those things,
Right.
when you're doing that kind of stuff, is it really worth the additional risk you take on by taking that approach for what potentially a few more percentage points on average over the long run? I don't think it is. But more importantly, from our standpoint, clients don't pay us to speculate with their money. They
Exactly.
pay us to invest their money.
Right.
try to preserve the principal and grow it.
Right. There's a reliable, that has been proven. And if we can stay on track with that, then over time they should perform just about as well as I would think doing this over the course of time. So
Right.
that's
Think about it, Jarrett. Just a couple of weeks ago, GameStop was selling at $349 a share. This week,
yeah,
it's trading around $50.
exactly.
So while some might have made money, it was only those that sold at the top. Now, if you get into something that looks like it's going to the moon and you only get halfway to the moon, are you going to hang on? I can tell you that there's a whole lot of behavioral bias when it comes to these sorts of things.
Big time.
And especially for those who get in at the very top, because what they'll do, they go rob the cookie jar and they put their $100 in the market.
Yeah.
It goes to 150. Next day, something bad happens. It gets drawn back down to under $100, and they think, man, if I just hang on, tomorrow's my day.
Yeah.
Before you know it, your money's gone.
Yeah.
So that behavior can be detrimental too, because it is exhilarating to some degree. I mean, if let's say you bought GameStop at 19 or wherever it was to begin with, and then it shoots up there, even if you can convince yourself to sell it and you take those profits, you're going to want to do it again because you got that thrill from making a call like that, and inevitably you're going to make a wrong call eventually.
Right.
And it could
It goes
just
the opposite.
Right.
And then you're pretty much break even.
Right. Well, there's nothing more soothing to me, and I kind of sit in the institutional investor's chair. There's nothing more soothing to me than finding a company that's got solid historical returns, solid historical cash flows that I can identify. I can project them forward, bring it back to present value, and find the price that is selling at a find a stock that's selling at a price lower than that intrinsic value in the market.
Yeah.
I'll do that all day. It gets very difficult in current when you're dealing with current situation, and especially these kind of things that make so little sense to me. It hurts.
Yes. Well, they are anomalies. I mean, that is a real term that is used to describe these things that happen in the market like that really defy the logic that we all know to be true, which is investors are rational, markets are efficient, so on and so forth. And that's really, it makes people start to think that things are changing, but this is just another example of what has happened for many years.
Right.
And will continue to happen most likely because, like we said, there is a place for speculation and there is money to be made by speculating. But I think when it comes to your nest egg, you really want to take a different approach. As Logan said earlier, carve some out, put it in a different account, and use that as your quote-unquote play money so that you can...
Gives you an outlet.
Right. Yeah. And you know what? I think that keeps people more engaged. It definitely, to me, seems like my clients that have that type of setup seem to be more engaged and even understanding of what we're saying when, we're saying something that maybe is going against conventional wisdom right now, like you need to be selling IT and buying energy. Yeah, that to us is exactly what needs to happen, but to them it doesn't seem as sensible. And I think that all kind of comes back to this distinction between investing money and speculating with money.